Amidst a lot of the market turmoil this year, I think something that stands out is non-US stocks outperforming the US. And actually, a lot of things today rhyme with the last time international embarked on an extended period of outperformance back in 2001. We'd just come off the 90s, a decade of US stocks outperforming, powered by great businesses, great innovation here. The internet, it was all sort of rooted here in the US. So earnings were strong. But we also saw the dollar strengthening for a decade, a couple hundred basis points per year. We saw a big valuation gap open up between US and non-US companies. And I recall people saying, well, that's okay. Why bother investing overseas? All the great businesses are here. There's a bit of the US is different. And of course, right when everybody decided that, the US went nowhere for a decade and international outperformed. So today it feels it's very similar. Right? We've had maybe 14 years now of US outperformance driven by great businesses, innovation, more earnings here. The dollar's been strengthening for a decade, and you've seen that valuation gap widen again. Once again, kind of excused by US exceptionalism. Why bother? Why bother with international companies? All the great businesses are here. And I think it sort of peaked following the election last year. People got like, oh, wow, it's really the US is going to continue to do well, the dollar is going to strengthen. And we get to this year, and amidst the uncertainty, all of a sudden we've seen US stocks fall, international stocks actually go up. We've seen the dollar weaken. And the last time we saw the dollar weakening, US stocks falling, it was also back in 2001. So the question is, today, can we continue to see international stocks outperform over the next few years? So, I think it makes sense. Why don't we walk through some of the reasons we think that might happen, Apurva?
I think maybe, Ray, the first thing to talk about is tariffs. We don't know what the policy will look like. It seems like there's changes every day, but I think tariffs are bad. Bad for companies outside the United States, bad for US companies and their potential competitiveness abroad. Globalization has been such a tailwind for the United States, for China, but also the world. I would say that the wealth effect and the prosperity that's been generated by companies and countries being cooperative with each other. I would say, interestingly enough, that when you look at the last several years and the impact of the first round of tariffs we saw 5 or 6 years ago, that global trade continues to do well. And so I think the question is, as the United States pursues a policy of tariffs and you see retaliatory tariffs on top of that, what does that actually mean? If global trade is continuing to do well, perhaps you are starting to see the United States begin to squander that leading position that it has.
Which I think is another interesting point, that global leadership the U.S. has shown, sort of stability of policy, stability of institutions, sort of driving for that change, I think is part of what underpins that idea of U.S. exceptionalism and underpinning the premium valuation awarded to some U.S. stocks, and actually, why the U.S. dollar is a reserve currency for the world, and also why the dollar's been so strong. So to the extent that there's some of this uncertainty around those things and some abdication of that leadership, it feels like that could also be a positive for non-U.S. stocks, right? You could have that valuation premium evaporate a bit for the U.S. You could also see what we've been seeing today, the dollar continue to weaken, I think.
Well, I think that's exactly right. So if you think about the enthusiasm over Europe today and the outperformance of European markets, maybe as much of people moving away from the U.S. as it is about maybe some changes that are happening in Europe. You have more unity, less regulation going forward, more investment as countries like Germany relax their fiscal constraints, and more monetary support. And I think that the narrative is changing a little bit. I think previously Europe is seen as slow-moving, bureaucratic, the ECB kind of behind the Federal Reserve in decision-making. Now it all feels that Europe is looking a little bit more on its front foot these days. I think when you kind of bring that to the company level and what you're seeing, you mentioned this idea of U.S. exceptionalism and the best businesses found in the United States. I mean, I acknowledge that earnings growth in U.S. companies has generally been a little bit better, but the Magnificent Seven is very much a double-edged sword today. They drove the concentration of market returns in the United States in 2024, but there's certainly been a reversal of that, and the pain in the markets in the United States today is quite acute.
And I think some of that reversal, if we think back to this year, is when DeepSeek announced how strong and how efficient and effective its model was. And that news was certainly a shot across the bow of US-based hyperscalers, but I think it also highlights there is innovation beyond the US, right? Even within AI, when you think about who makes all of NVIDIA's chips, TSMC makes all of them. What equipment do they use to make it? It's all from ASML in their EUV equipment. So sort of a monopoly from a Taiwanese company and a Dutch company, or even the inputs there, a less well-known company like Disco in Japan. They slice, dice, they actually polish the wafers that they use in making those chips. They have something like a 70% market share, and it's a critical niche component, obviously, to the whole infrastructure and AI sort of supply chain. Again, these are non-US companies. Even outside of tech, you've got a company like Schneider Electric based in France. They do energy management equipment and services and software around that. So people thought about it for green energy, but the reality is they've got a fantastic and fast-growing business helping build out AI infrastructure. Those AI data centers need very efficient and consistent power. I think it's grown to something like 20% of their business from almost nothing not too many years ago. Healthcare, I think, is another area of innovation outside of the US. And anti-obesity sort of drugs, weight loss drugs, have certainly been a focus of the markets and the healthcare sector. Novo, the Danish company, was sort of the leader in that. Certainly they're competing today with Lilly. But I think when we look forward, what people are looking for is not just the weight loss, but the convenience and a better safety profile, fewer side effects. So Lilly is coming to market, or they've taken to phase 3, once daily oral GLP-1 drug. That would certainly be more convenient. But interestingly, the science behind that is from Chugai, a Japanese-based company. And when we think about lower side effects, Roche recently did a deal to co-develop drugs with Zealand, a Danish-based company. It's still an injectable, but far fewer side effects than Ozempic and Wegovy and Mounjaro. So again, a lot of innovation for future growth is coming from non-US healthcare companies.
I think that's a really good point, Ray. And when you look at, for example, the number of top 20 cash flow return on investment businesses, you mentioned kind of areas of innovation like healthcare and technology, industrials. There are other sectors as well, and you do see a preponderance of high quality growing businesses in those sectors outside the United States. I also think if you look at the ACWI benchmark, of course, the United States has a large weight, 67% weight to the US and 33% to international. But when you slice it by market cap and look at the number of companies greater than 5 billion in that high quality growth universe, it's a very different skew, and you get 73% of the companies outside the United States in that high quality growth universe. So certainly the monopoly on innovation does not belong to the United States.
Right. Yet, it's still not reflected in valuations. And you see sort of the widest gap we've seen in 20 plus years, actually ever, I think. And it feels like that could close. We've listed quite a few different potential pauses. If any one of them happen, it feels like that could narrow that gap and lead to some international outperformance, hopefully with rising markets. But the reality is, it could also be a powerful defense, a diversification international. If things are going awry, that valuation can provide some support in down markets, along with the quality growth of the businesses. And outperforming in down markets is actually almost more powerful than on the way up, right? If you think about the magic of math, if a stock falls in half, it has to double to get back to zero. So international markets could outperform on the way up, but there's also a good chance that they could provide protection if markets get difficult in the coming years, I think.
I think that point on downside protection is a good one. I also think it's worth mentioning from a style perspective that growth and value have had very different experiences outside the United States, and growth stocks in the last 3 years have significantly underperformed to the tune of 30 percentage points of a gap unannualized versus value stocks. So to the extent that you're looking at international markets and looking where to put that marginal dollar, I think growth stocks are pretty interesting right now.
Yeah, I think so too. I think international markets definitely have the potential to perform well over the coming years.